Hello and welcome to Being a Hard Money Lender in the Financing Course with Sarah and Jan. To start, let me mention that hard money loans have recently overcome the stigma that they could only be used by those who are trying to get out of foreclosure or by investors with bad credit. Now more than ever, hard money loans are a great answer to a wide variety of loan scenarios that fall outside traditional banking guidelines. And by now, you should know how to find hard money lenders. However, in order to be an effective and successful hard money lender, you need to have a functioning knowledge of how the real estate market in your area works. Therefore, it's highly recommended that you take some time to achieve success as an investor before turning your focus to hard money lending. One of the reasons for this is because if you have a steep learning curve right when you get into hard money lending, your inexperience could end up costing you quite a bit of money, or at least cause you to miss out on a lot of potential profit. So as you're considering whether to become a hard money lender, here is some simple advice. First, start where you're at. By starting in the area in which you live, you'll be better able to understand market trends and things you can predict, such as oncoming trends. Second, specialize in an area. Ideally, as a hard money lender, you'll know your area better than anyone else and know what people in the area need better than anyone else. Third, focus on property types you're familiar with. For example, if you as an investor focused on single-family residences, then as a hard money lender, you should also focus on single-family residences, since that's what you know best. Now, as you gain more experience as a hard money lender, you can and should branch out into less familiar property types. But initially, stick with what you already know. Also, if people know you specialize in a particular area or property type, they're more likely to trust coming to you for money. Fourth, find a trusted accountant and attorney and retain their services. As a hard money lender, there are many legalities you need to make sure you're following, and those legal rules change from state to state. So it's in your best interest to have an attorney on hand to ensure you're doing everything according to local law. Also, the accountant can help track your money and make sure you're staying within profitable bounds with what you lend. And finally, join an investors club in your area. When you go to the club meetings, network, and network. Not only will you create business for your hard money lending, but you could also find someone to whom you could refer a deal that doesn't meet your lending criteria and turn a profit on the referral. Through the remainder of this lesson, you'll learn more about these points of advice as well as the ins and outs of becoming a successful hard money lender. Let's get started.
Fantastic. Well, allow me to welcome you to this lesson as well. It should be a very interesting one for you, and our hope is that you will be prepared to make great money as a hard money lender by the end of this lesson. But before Jan and I get into the lesson material, I would like to review some of the things you should know that will help you understand the information we will present. First, you should have a commanding understanding of the basic principles and terminology used in real estate investing. Second, since we recommend achieving success as an investor first, you should know what kinds of properties you are interested in. As part of that, you should have a solid understanding of how and where to get those properties. You should feel comfortable performing an income property analysis as well as some of the other basic investing strategies that have been previously discussed. Now, let me turn the time over to Jan, and she will explain what we will cover in this lesson.
All right, thanks, Sarah. I too would like to welcome you to this lesson, one of the more eye-opening ones in the financing course. Sarah and I are going to cover some great information in this one, so I hope you've got some paper and a pen handy to take some good notes. Here's a list of some of the main points we will discuss. We'll talk about what hard money lenders are and the various types of hard money lenders. We'll explain the benefits and challenges of being a hard money lender and teach you about several places you can go to get money to lend. By the end of the lesson, you'll be able to determine your lending criteria as well as your ideal people to lend to and properties to lend on. And finally, you'll leave being able to identify some laws that may affect you as a hard money lender and the various ways to protect your money once you lend it. Armed with all of this information, you'll be set to make great money by being one of the most sought-after hard money lenders around. So, with nothing further, Sarah, will you start us off with our tips for success?
Absolutely. Being a hard money lender requires the ability to manage time and be organized. To that end, here are some great tips for how to do better at each. First, plan each day. Use a planner or online calendar to help you see what appointments you have each day so that you don't overbook yourself. Also, consider having a daily to-do list included in your daily planner or calendar. Seeing what needs to be done each day can help focus your energy and keep you on track. Second, prioritize. Many people unknowingly spend a lot of time on things that aren't very important. For example, you may spend a large amount of time checking emails or updating your social network profiles, MySpace, Facebook, LinkedIn, etc., and checking on friends there when you have much more important tasks to complete. Having a prioritized list can help you stay focused on the things that will help you build your business. This third tip is a big one. Say no. When non-essential things come up that will take a lot of your time and make it so that you can't accomplish many of your tasks, simply say no to them. Sure, some of those non-essentials will be more fun than your important tasks, but you need to ask yourself if they will help you build your business. If they don't, gracefully decline. Fourth, delegate. This is one of the secrets to some of the most successful people in the world. See, no matter how organized and focused you are, there are still only 24 hours in a day. Sometimes you just can't do everything on your own. When that's the case, let others who are capable help you out. You'll find that you can reduce a great amount of stress by delegating to trusted helpers. Number 5 here is one of my favorites. Practice the 10-minute rule. As you build your business, inevitably, there'll be important tasks that need to be done that you simply despise. However, rather than avoiding them, work on them for 10 minutes every day until you either finish the task or learn not to hate it so bad. And finally, one that most people enjoy but can't always seem to do, get plenty of sleep, have a healthy diet, and exercise regularly. Maintaining good health not only increases your ability to focus, but also reduces sick days and lazy days, those where you really can't get much done even if you try. Review these tips, get yourself organized, and get ready to make some great money as a hard money lender.
As you have learned from previous lessons, hard money is money that can be borrowed from an individual or group of individuals. Hard money loans first started showing up en masse in the 1950s when the credit industry first started to undergo significant changes. They came about as a result of buyers wanting and needing capital, but due to credit restrictions, being unable to get it. As time went on, hard money became more and more popular. That is until the real estate crashes of the 1980s and 90s, when hard money loans suffered significantly due to the lack of real estate buyers. However, recently, hard money has made a significant comeback and is now, more than ever, a great method of obtaining funds for investing.
One of the distinguishing marks of hard money loans is their high interest rates. These rates are high as a means of protecting the lenders from the considerable risk they undertake by lending their own money. One of the other ways the lenders protect their money is by making sure the loan is backed by or collateralized by something physical, in this case, real estate. That way, if the payer defaults, then the lender has something tangible to take back in return for not receiving their money. But not all hard money lenders use just their own money. Some of them create a pool with other lenders and have a broker lend the pooled money to real estate investors. In fact, most hard money lenders are brokers. Some are both lenders and brokers. By doing both, they can choose to fund a deal or refer it to another lender with the possibility of collecting a referral fee. Now, when a real estate investor decides to become a hard money lender, they don't need a license to do so because they are risking their own money and can essentially do what they want with it. But when a group of investors come together to loan money, they are required to have a license since they are dealing with other people's money together with their own. Different states have slightly different rules for what kind of license needs to be obtained. So if you're interested in pooling with others, make sure you check and double-check your state laws and act accordingly. Another distinguishing feature of hard money lenders is that they tend to lend on higher risk deals than most conventional lenders. Investments that need extensive rehabilitation, foreclosures, raw land, developments, commercial properties, and other non-traditional investments are the hallmark of hard money lenders. You can see from this list that there are a lot of areas hard money lenders can be involved in real estate investing. That's one of the reasons for their recent comeback. But that is also one of the reasons why you should specialize in one area first, then expand your lending as you become more familiar with the business and build a solid reputation.
You might also notice that with hard money lenders, their loan times are different than most conventional lending sources. For example, it's common for a bank to lend their money for 15 to 30 years, but hard money lenders might loan their money for as little as a week up to several years, but generally not more than 5 years. Also, when hard money lenders evaluate a borrower, they are less interested in the borrower's credit and financial situation than they are in the property value and the investor's plan concerning the property. They want to see well thought out investing strategies, well developed exit strategies, and a very clear indication of how the property will make money so they can be sure they receive their money in return. At times, hard money lenders will even do their own due diligence and appraisal on a property just to further ensure the safety of the loan they're considering. Another distinguishing feature of hard money lenders is that when they consider a loan, they'll often look at it from one of three perspectives, either by its after repair value, loan to value, or its investment to value. Let me give you a brief explanation of each. The after repair value, or ARV, is the value of the property after it's been fixed up. Most hard money lenders will lend at 60 to 65% of the ARV, but some might lend at a higher ARV, depending on the property and the borrower's experience. That means that if you buy a property that'll be worth $100,000, when all needed repairs are complete, you could borrow up to $60,000 or $65,000 from a hard money lender. Now, depending on your purchase price, that amount could include enough money to cover closing and/or the repairs themselves. So, it's important for the borrowing investor to be able to negotiate well with the seller to make the most of the hard money loan.
The loan to value, or LTV, is essentially exactly what it says. It's the borrower's requested loan amount as compared to the current fair market value of the property. In previous lessons, you learned how to calculate the fair market value of a property. Well, LTV is simply a percentage of that market value without considering any other loans that may be in a higher position. You'll find that lenders will be all over the board when it comes to what LTV they'll offer. Many times the LTV is in direct correlation to the perceived risk of the loan, where the higher the perceived risk is, the lower LTV they'll offer. For example, suppose investor Jim buys a property for $215,000 and has some good comparables that show the current market value to be $300,000. Jim estimates the property needs around $10,000 in repairs. The hard money lender then calculates the LTV for the property to be 75%. $300,000 fair market value divided by the $225,000 total investment equals 0.75 or 75%. That seems like a good LTV to the lender, so he and Jim work out a deal where Jim gets $225,000 to buy and fix the property, and he will pay 3 points, $6,750, up front with a 13% interest rate on the loan that is due after 6 months. Now Jim can buy, fix, and sell the property with potentially only the $6,750 out of pocket.
The third way hard money lenders evaluate loans is by looking at the investment to value. Investment to value is a measure of how secure a creditor's position is, as well as how likely they are to recoup their money in the event of a foreclosure. Investment to value is typically only used if the investor is planning on issuing a second position loan. Investment to value is calculated by adding the amount of money the investor has put into the mortgage to any senior liens existing on the property and then dividing that sum by the property's current value. For example, Betty buys a home for $110,000 that needs roughly $5,000 in repairs. Betty already has a first position loan from Frank Bank for $100,000, and she approaches Bob Hard Money Lender and asks him to give her a second position loan for the remaining $15,000. Well, after doing his research, Bob finds that the property is worth $179,000. Bob's maximum ITV is 65%, so he decides to give Betty the loan. But since Bob's loan is in second position and therefore more risky, he'll charge Betty 5 points payable up front and 17% interest for 4 months. Sounds like the deal will happen, but the question you need to ask is, how did Bob determine the deal fit within his 65% investment to value parameter? Well, the first position loan was for $100,000. Add to that Bob's second position loan of $15,000, and then divide the total investment, $115,000, by the value of the property, $179,000, to get 0.64, or 64% ITV. As a side note to this example, the higher the ITV, the riskier the investment for the lender, which means that the lender will generally charge higher points and interest rate.
There are two kinds of hard money lenders you'll encounter, private and conventional. Each functions differently in their lending practices, and it's important to know the difference so you can decide which best meets your wants as a hard money lender. I'll explain how each works here. Private hard money lenders are exactly that, private. They only loan to people in their lending area, or what used to be their investing target area. Private money loans are usually a bit more creative than those you would get through conventional hard money lenders, but the private lenders are willing to do the more risky loans because they know the area very well and know they can get their money back even in the event of foreclosure. However, the big thing private hard money lenders like is a good investor who they know and in whose investing practices they have confidence. See, if they trust the person they are lending to, then they can often be very creative in what they offer and even take more risk than they typically would. But it all comes down to how well they know the investor. Here we see yet another reason why it's good to start as an investor before getting into hard money lending, because you'll get to know investors who become hard money lenders, and you'll know who the good lenders are and who are a little shady in their deals. One thing to note about private hard money lenders, most of them don't advertise their services. They are typically only discovered through word of mouth, which is, of course, one more reason why it pays to be an investor before being a hard money lender, so you can establish a network of people who know you and know what a good investor you are. The second type of a hard money lender is a conventional lender. Conventional hard money lenders lend on deals that are more risky than traditional lending sources, such as banks, but not as risky as private hard money lenders. Some of the reasons conventional hard money lenders are less risky in their loans is because they're typically a group of individuals coming together and pooling their resources, so it's not always just their own money they're working with. One of the small drawbacks to lending this way is that it requires additional licensing requirements and guidelines to be met. Another reason they're more conservative is because they typically have overhead. See, conventional lenders generally operate as businesses who advertise and have a center of operations, either a leased office space or some other kind of business establishment. So they have considerably more overhead than do private lenders. Therefore, they have to be a little more careful with their money. But because of their business-like nature, they serve more areas than just locally. In fact, many conventional hard money lenders lend on a nationwide basis, making them considerably easier to find. Most conventional hard money lenders have more rigid guidelines and lending criteria as well. Often they'll require more paperwork before issuing a loan. They'll be more interested in the borrower's credit score and financial history, and they may require more documentation on the property. If you decide to go this route, you should consider talking to an attorney so that you understand all the laws that apply to you as a lender at both state and federal levels. Because as has been mentioned before, when you pool money, there are additional requirements that need to be met or you'll be violating the law.
Excellent. Please evaluate the information Sarah just gave you and decide which kind of lender you'd most like to be. But know that either one you choose, you'll gain many advantages for being a hard money lender, and you'll face certain challenges as well. In this part of our lesson, Sarah and I will discuss some of the advantages and challenges in store for you. One of the most notable advantages to being a hard money lender is that you get a great return on your investment. Depending on your state's laws regarding hard money lending, you can charge fairly high interest rates that help protect you as well as bring in some nice profits. Also, those profits will come in quickly due to the shortness of the loan period. Another advantage is that you'll have people bringing properties to you, and you can be rather picky about who you work with and which properties you loan on. As an extension of this, there will be times when you'll actually own some of the property you loan on simply because the person who borrowed from you didn't make their payments and you foreclosed. Then you can do whatever you want with the property to continue making money. A third huge advantage is that you can change your strategy anytime you need in order to maintain a certain rate of return on your money. So if the market starts to decline, you can change your rates and terms to maintain clients. This gives you absolute control over how much risk you're willing to take on, as well as how much you're willing to lend. Similarly, you have the choice to diversify your funds into various types of hard money loans based on what you need and how the market is behaving. Another unique advantage to hard money lending is that you can start or stop lending anytime you wish. This is especially beneficial if you've been an investor prior to being a hard money lender. See, if for some reason you decide you don't want to lend anymore because of your involvement in the investing world, you already know what's happening where you are and can act accordingly. Also, especially if you choose to be a private lender, you have very little overhead and virtually no startup costs, and you can get started whenever you wish. Finally, all of your investments made as a lender are secured by the most stable collateral in the world, real estate. So even if you don't get your money back from the borrower, you have a piece of property you can foreclose on and resell to recoup any losses.
All in all, there are some great advantages to being a hard money lender, but unfortunately, not everything in the hard money world is perfect, so there are some challenges you should be aware of. The first challenge is that you have to understand real estate investing in your area in order to maximize your profit and minimize your overall risk. If you don't have a thorough understanding of how investing in your area is going, you should seek to get that understanding before you start lending. Second, you need to have a good system for tracking payments due and payments received. If you don't have a good tracking system, you could lose money by being unaware of people with late payments. Along with knowing about late payments, you need to know how late the payments are so you know if you need to foreclose on the property, which, speaking of foreclosing, can be considered either a challenge or a benefit. It's a challenge simply because it's one more thing you need to do to recoup your money, and it can be difficult, time-consuming, and expensive at times. However, it can be considered an advantage since you could become the owner of a great investment property that will continue making you money. Another challenge is that if you're not careful, you could lose a lot of money from bad loans as well as in penalties for breaking state lending laws. It's very important as a hard money lender to make sure you do your due diligence so you know the investment value of the property in the event things go wrong with the borrower. It's rare for that to happen and have negative consequences, especially considering that the loan is backed by real estate, but it can, so you need to be aware of it. Similarly, You need to be familiar with your state's lending laws so that you don't violate any of them and have to pay stiff penalties or run the risk of your contract being declared null and void by a judge. And finally, you might have to evaluate a lot of bad deals before you find one that meets your lending criteria. Remember, you are using your money to lend, so you should only lend it if the loan makes sense to you. Speaking of the money being yours, where will that money come from? Jan will give you some great options to look at and see what will work for you.
More than likely, up to this point, you've been under the assumption that you have to have a lot of personal money available in order to become a hard money lender. Well, surprise, that's not necessarily the case. In fact, there are several ways you can get money to lend, even if you don't have a lot. So the first question to address is, really, how much money does it take to become a hard money lender? Well, the answer to that depends on what kinds of properties you want to invest in, what those properties' market values are, what kind of lending you want to do, and where your money comes from. For example, if you're in a market where single-family residences can sell for as little as $10,000 to $30,000, then you could start being a hard money lender with just a few $1,000s. However, if you're more interested in lending on commercial property or large apartment complexes, then you'll probably need hundreds of thousands to get started. Regardless of what kind of property they focus on, most hard money lenders have more than one source for the funds they lend. Some have large sums of cash available, some have large lines of credit, or they may have other investors who have pooled their money together. If you are interested in having people pool money together, you need to be extremely careful doing so. There are some very specific Securities and Exchange Commission, or SEC, laws that control exactly what you can and can't do that need to be followed precisely. Otherwise, you may have major legal problems. So, if you want to work in a pool with other lenders, you really should consider working with an attorney who is familiar with SEC rules and regulations. In some cases, you may decide that you don't want to start your own hard money lending business right away, but would rather work with an already established group of lenders. This can be a great option to get started, as the other lenders would have already cleared any SEC rules and regulations, and will allow you to contribute money to their pool and join their lending group. However, before turning your money over to them, there are some questions you should find out about them and how they manage their funds. Here are 15 questions you should have the prospective investing group answer before joining with them. Review these questions and make sure you get clear answers to them to help you decide if you would like to become a hard money lender with an already established company.
Excellent. Now it makes sense that you'll have many more options with hard money lending if the money you lend is already yours. You'll have more flexibility with it, and you'll make significantly more money over time by making short-term hard money loans than letting that same money just sit in a bank or wherever else it may be. But where does the money really come from? Well, the answer is really limitless. Some people inherit it, others have it from other businesses, but some got it from investing in real estate. And for those whose money came from investing, depending on the investing path taken, a person might already have a good clientele for hard money lending. For example, if you started as a bird dog and then after making good connections there, moved on to investing on your own, and then moved on to hard money lending, then you have two groups of people with whom you already have relationships that will come to you to use your hard money. See how all these investing strategies can build on each other? Now, if you've been investing and still have some properties, you might consider taking a look at what the conventional lending world is like and seeing if you might not be able to refinance a loan or two that you have and using the equity from the refinance to begin hard money lending. For example, you might use a home equity line of credit or a home equity loan to generate funds to lend. You just need to make sure that the interest rate you lend at is higher than that you are required to pay. Then, just like that, you can use other people's money to loan and make money from. If, by chance, you have forgotten what home equity lines of credit and home equity loans are, please go back and revisit the financing lesson of the Real Estate Basics course for a refresher. Another way to get money is through a personal line of credit or a personal loan. If you already have one of these options or can qualify for one, they can be great ways to get money to start you out as a hard money lender because, again, you are using someone else's money to make money. So how do they work? Here's a description of each. Personal lines of credit can be either secured or unsecured. Unsecured lines of credit are sometimes called signature loans and are based almost solely on your credit worthiness. The funds you qualify for are set aside for you to use whenever you need. But you need to look at your loan agreement carefully, as some banks will make you pay fees if you don't use the money by a specific time, or they may close the loan account altogether if the money isn't used. Personal lines of credit are considered to be revolving lines of credit since, as you pay down the principal balance, the amount you have paid down becomes available for use again. As you use the money, you are required to pay monthly payments plus interest, and the interest can vary or be fixed. Make sure and read the loan agreement carefully to know for sure which kind of interest rate is attached to your line of credit. Most times, the available money will be placed on a credit card and will have some fees for cash advances, transfers to bank accounts, and checks. Again, make sure you read the agreement very carefully so you know exactly what those fees are going to be and whether or not it would be better for you to pay down outstanding balances or hold on to the money and reinvest it without paying the extra fees again. Some banks will offer secured lines of credit. These lines allow a person to borrow higher amounts of credit because the credit is secured by a savings account, CD, or other investment. Recall with the unsecured line, there is nothing backing the credit other than the borrower's credit score. But with a secured line, there is something tangible backing the borrowed money, so it's considered a safer line of credit. Banks and credit unions are the best places to get secured lines of credit as they typically will offer fixed interest rates and no time restrictions for the money to be used. And if you have a good relationship with the bank or credit union, they may even offer no fees or reduced fees for accessing the money through checks, cash advances, and transfers. You can also get personal lines of credit through credit card companies. But if you choose to go this route, make sure you read the agreements very carefully to ensure you know how the interest rate will work, whether it is fixed, variable, or fixed only for a certain amount of time. You also need to know what kinds of fees they will charge for cash advances, transfers, and convenience checks. It is very rare to find a credit card without several fees attached to it. So again, make sure you understand what you are signing when you get one.
Personal loans are unsecured loans that you qualify for based on your credit worthiness and current income. Personal loans are not revolving, so as you pay down the principal, you just simply pay down the principal. There is no credit accrued by paying. However, personal loans are amortized, meaning there is a specific time the loan can be out and a specific payment schedule with built-in interest. At the loan maturity date, the entire loan needs to be paid off, else you incur more fees and or a significantly higher interest rate on the remaining balance. If, after the loan maturity date, you need the money again, you need to reapply and go through the approval process again. With personal loans, there may be a prepayment penalty, meaning you are penalized for paying the loan off before a certain date. Sometimes you can negotiate with your bank or credit union to eliminate prepayment penalties. For hard money lending purposes, this would be a good idea to try, since you're using the money for short, hard money loans. If you can't eliminate the prepayment penalty, then either make sure your hard money loan extends past the prepay penalty date, or give a series of short loans that extend past the prepay date. If you have a registered business, then you can also look into getting a business line of credit. Business lines are very similar to personal lines in that they are typically unsecured, based on your credit worthiness, can be revolving, require monthly payments including interest, and can be accessed via transfer, check, or credit card. The biggest difference, and the one that is most beneficial, is that once your business has established credit of its own, the business line of credit is kept totally separate from you and your personal credit, meaning your name won't be attached to the credit, nor will it show up on your credit report. Business lines of credit are rather beneficial and important to investing, so they'll be discussed in more detail in their own business lines of credit lesson. Another money source is from a self-directed IRA. This is one of the most risky ways to get money since you're using your retirement to fund a deal that has the potential to go bad. So if you decide to go this route, make sure you evaluate all possible potentialities before signing the proverbial dotted line. As a means of keeping some of that retirement money safe, you could talk to your IRA's custodian and see if you could divide the available funds into multiple IRAs and only use one for hard money lending. In the Retirement Funds and Self-Directed IRAs lesson, you can learn more of how these investments can be used to invest in real estate.
Fortunately or unfortunately, there are no typical hard money loans per se, since an individual can really do about what they want with their own money. However, there are some common trends that are worth knowing about. Some of these trends were mentioned in the Working with Hard Money Lenders lesson, but here are a few others to make note of, especially when deciding what your lending criteria will be. As a brief side note, recognize that if you are using your own money, you can manipulate a loan virtually any way to fit yours and the borrower's needs. But always make sure you are lending within the confines of your state law. Having said that, here are some things you can expect from most hard money lenders. The first trend is that many hard money lenders don't like to lend on land simply because it's harder to generate income from. Now, if the borrower has a detailed plan of how they plan on developing the land, some hard money lenders will take a closer look. But if they decide to lend, it will generally only be in the range of 50% LTV. Second, most hard money lenders aren't excited to work with inexperienced investors. In fact, some require documented experience for several deals before considering lending their funds. They like to work with professionals they can trust and those who have solid experience. Third, while not all hard money lenders pull an investor's credit, they will generally look to see if there have been any bankruptcies, foreclosures, charge-offs, or collections. Most hard money lenders' primary concern is the potential borrower's net worth and income, at least enough to cover the loan if things on the property don't go exactly as planned, or to cover the loan in the event of total default, not creditworthiness. A fourth trend is that a lot of hard money lenders have inspectors they work with on rehab project loans. Many times, the lender will require a draw request form that identifies the repairs that have been completed. Then the lender sends out their inspector to take a look at exactly what repairs have been made and if they have been done well. If everything comes out to the lender's satisfaction, they will release the next amount of repair money. Some hard money lenders require copies of your comparables as means of validating the potential purchase price and value claim. In some cases, the hard money lender will require an appraisal before approving the loan, but generally the comparables are sufficient. The sixth trend is that almost all hard money investors want a detailed outline of the exit strategy the investor plans on using. Refinances and sales are the most common exit strategies, but whatever is proposed by the investor had to be realistic within the time frame the hard money lender places on the loan. Also, as a general rule, hard money lenders adjust their interest rates and fees based on the perceived risk of the deal. As a general rule, the interest rate hard money lenders charge is between 10 and 18%. And the points are anywhere from 2 to 10. So it's in the investor's best interest to show the least amount of risk in a transaction they hope to fund with hard money. A majority of hard money loans are for rather short terms, anywhere from a few days to a couple of years, but rarely longer than 3 years. Another common trend is that in general, hard money lenders won't lend more than about 50% of the value of unimproved land, 60% of the value of an underperforming property, and 65% of the value of a stable income-producing property. However, some hard money lenders lend as high as 75 to 80% ARV, but they are not common. Some hard money lenders like to bolster their earnings by charging application fees, due diligence fees, and/or a commitment payment, sort of like earnest money. In some cases, the lender will allow the fees to be incorporated into the loan, but others might require the fees to be paid up front. A rather common trend in hard money lending is that almost all hard money lenders, like any other lender, prefer to be in first position. There are hard money lenders that will consider second and a few even third, but if they can be in first, they certainly prefer that. The final trend to note is that in the event the value of the property in question isn't enough to cover the existing mortgage, hard money lenders may cross-collateralize the loan with another property. That means that if the borrower defaults, the lender has interest in more than one property as a means of recouping their money. These kinds of loans are generally referred to as blanket mortgages. If the lender doesn't do cross-collateralized deals, they'll simply not lend on that property. So, as you can see, there are many trends hard money lenders follow to vary what they offer. And if you've come to hard money lending by way of investing, then you'll have a better understanding of what lenders in your area are doing with their loans and what they're requiring. However, regardless of what others are doing, it's important for you to determine your own lending criteria while making sure to stay competitive.
Before you start handing out money to investors, there are 7 questions you need to know the answers to concerning your lending criteria. Keep in mind what you decide today may change over time and with market fluctuations. But it's imperative that you have a solid base to begin from, and these questions will provide you with that base. The first question is, what types of properties will you finance? Most lenders will begin by lending on properties they have experience with as investors. Others decide to start with single-family residences because of the reduced risk generally associated with that property type. Whatever type you choose, you need to be familiar with the evaluation process, resale, and current value of the properties. You also need to consider if you are going to loan to investors only or to owner-occupants. Generally, it is wiser to lend only to investors, since by lending to owner-occupants, you'll be more closely scrutinized and restricted by your state and its laws, as well as be expected to lend for longer periods of time. The second question is, what areas will you finance? Some property types are great investments in one area and bad investments in another. Knowing your target area will help you eliminate potential problem properties and allow you to focus on those that work best for investing in the area. Third, what are your loan ratios going to be and what will they be based on? Recall, hard money lenders lend according to ARV, LTV, or ITV. You need to decide which one makes the most sense for you to start with, and then what ratio you feel comfortable with. You need to decide if you want to get a lot of clients by taking on more risk and offering higher ratios, or if you want to offer different ratios based on the investor and the property. The fourth question is, will you offer second or even third position loans? Look very closely at the amount of risk associated with anything but first position loans and decide if you're willing to accept that amount of risk in your loans. To help out with this decision, it's a good rule of thumb to avoid second position loans unless you're able to pay off the first position loan if there's a problem. Similarly, you may not want to do second position loans where the first loan is with a private investor simply because if there are problems receiving payments, the private investor will move much more quickly than a bank, and they may not let you know about their foreclosure filing. See, if you don't have any kind of notification on the title, then you may not hear about the foreclosure until it's too late, in which case you would need to take the borrower to court and try to get a judgment against them as a means of getting your money back. You could also consider cross-collateralizing the loan if you want to do second position loans. Fifth, how many points and what interest rate will you charge? Like the ratios, the amount of points and interest rate you charge will probably be based on the overall riskiness of the deal. In some cases, you'll need to take into account the interest you are paying on your money, if you borrowed it, and make sure the interest you charge is higher than what you pay. The amount of work you do to verify the loan also has a bearing on how much you charge a borrower. The more the work, the higher the points and interest. Sixth, how long will you let the money be out? If you've borrowed the money, you need to make sure the loan you give comes due before the loan you borrowed. Also, the exit strategy the investor is planning on using could influence how long you allow the loan to go. You should also consider the risk of the deal and the amount of return you would like to get when deciding loan time. And finally, will you charge a prepayment penalty? Typically, it's not in your best interest to charge prepayment penalties. But if you absolutely need the money to accrue interest for a specific amount of time, they can be beneficial. Most investors won't be as excited to work with you if they know you have a prepay penalty as well. So by including one, you could actually be reducing your potential clientele. Look over these questions, study them, and formulate your answers to them to help you know what kind of lending will best suit your wants and needs.
A hard money lender, there are several profiles you should be concerned with. In this section, we will discuss those profiles and what to look for in each. Let's start with one of the most important, the borrower profile. The borrowers you work with are going to include a wide range of investors with a wide range of experience. Some of them will be focused on fast cash. Others will be interested in buying, fixing and selling, or even holding on to the property. Many times, the properties these investors work with will be distressed, either physically or financially, allowing the investors to pick them up for 40 to 65% of the ARV. This kind of ARV might fit right in with your lending criteria and, if so, might be a good borrower to consider seriously. Also, a lot of times you can get an idea of the investor's ability to have the project go according to plan or closely to plan so you can get your money back in a relatively short amount of time. However, if you're not comfortable lending on properties that need a lot of repair, or if you're not confident the repair estimates are accurate, you can loan to a different type of borrower. For example, you might consider doing bridge loans to people who have money, but who also have much of that money tied up in other loans to such a degree that they can't finance another property until they can release some of those funds. There are a myriad of other potential borrowers, and it is really up to you to decide which ones you feel comfortable lending to. Land carries the highest risk of all the property types since it typically doesn't produce income on its own and is slower to appreciate. Land can come in two forms, raw or improved. Raw land is exactly that, just a bunch of dirt with no improvements whatsoever. Improved land, though, is graded and has utilities and amenities, just no actual building. Improved land is much more desirable to lend on since it holds a higher value than raw. When looking at land, you need to know the zoning requirements associated with it. Common zoning types, which may contain subtypes, include residential, commercial, industrial, and rural, with some properties having mixed zoning. If you decide to lend on land, make sure that you know all the restrictions with each zoning type as well as the investor's plan for the land. Commercial property is another high-risk property type. Strip malls, industrial parks, gas stations, convenience stores, and office towers are all examples of commercial property. Two great things about commercial real estate are that it generates income and appreciates over time. However, the value of the property is generally directly associated with its ability to produce income. So if you're interested in lending on commercial properties, you should always have the investor provide you with information concerning the property's rent history and a cost analysis of repairs or updates required.
The next property profile is multi-unit property. Multi-unit properties carry moderate risk compared to commercial properties since they are designed to produce income. Any property that has 2 or more units and focuses on residential occupancy is considered a multi-unit property. If you're interested in multi-units, then you should take the time to verify if the property is experiencing positive cash flow, that its code and zoning requirements are met, and that if there are any issues, the investor has the funds available to cover all necessary updates or corrections. Our next property type is either mobile or manufactured property. A little history. Trailer homes built before 1976 were called mobile homes. Then in 1976, Congress passed the National Manufactured Housing Construction and Safety Act, which assured that all trailer homes were built to highly regulated national standards. Soon after, these homes were called manufactured homes. Manufactured homes can have a minimal risk level because they can be so inexpensive to purchase and are generally easy to repair. Similarly, they can appreciate over time as well, though not to the extent that other forms of real estate do. The things that influence a manufactured home's rate of appreciation include the surrounding area, the overall condition of the park it's in, the condition of the home, the financing available to purchase it, the park amenities, and whether it's on leased land or if the land is attached to the home. If the land is affixed to the home, then sometimes these properties can be classified as single-family residences. One of the biggest risks associated with manufactured homes is that you have no control over how the park is maintained or the quality of the homes next to the subject property. For example, if the park manager allows a dumpy home to be placed next to one that is rather nice, the overall value of the nicer home will decrease. Similarly, if the park manager allows the park to deteriorate and raises the monthly lot rent, then, in a worst-case scenario, the home may be rather difficult for you or your investor or borrower to sell. For these reasons, there are hard money lenders out there who refuse to lend on manufactured homes. But if you have a few $1,000s, they can be a great way for you to break into the hard money lending market, especially if you find some so-called Lonnie dealers who specialize in buying and selling manufactured homes.
As a general rule, condos and townhouses are considered single-family residences that are connected by the physical structure of a single building. They're generally lower-risk lending investments because of their single-family status, as well as the fact that most of them are maintained by a homeowners association, or HOA. Typically, the HOA actually owns the structure and the homeowner owns the inside of the property and pays a monthly fee to the HOA for external upkeep. Condo and townhouse value is influenced by the number of amenities in the complex, the quality of the complex, and the national market trends. Also, condos and townhouses are more readily affected by changes in the national market, unless they are located in a military or college area. Most conventional lending institutions have stricter guidelines when lending on condos and townhouses because of the HOA's ability to assess fees and foreclose in the event the owner doesn't pay their monthly fees. Therefore, if you're interested in lending on condos and townhouses, in addition to the regular property information, market prices, exit strategy, etc., make sure you find out what the HOA fees are and how often they change. Single-family residences are detached, individual residential properties. These are the ideal properties to start hard money lending on since they have the largest amount of buyers interested in them and that interest translate into an easier time for your investor to sell or make money off the property sufficient to pay your loan back. Single-family residences generally withstand market fluctuations a bit better than other property types because of their demand. See, regardless what is happening to the economy, people still need a place to live, and people still want to own. Therefore, they choose single-family residences more than any other property type. thus making them the safest to begin hard money lending on. So those are the properties you might lend on as a hard money lender. Take some time and evaluate where your experience lies and where you want to start. Then, when you are ready, click Next and Jan will teach you about marketing your new lending business.
There are a lot of different ways to start and grow your hard money loan business. Many hard money lenders have an online presence of some sort, whether it's a website, blog, social networking profile, series of articles, podcasts, or even videos. Whatever other methods of advertising you choose, you really should have a website, especially since having one can reduce the amount of paperwork and communication time between you and your borrowers. With a website, you can quickly convey exactly what you do, how you do it, and what you require from your potential investors or borrowers. Additionally, if you provide some great information sources such as articles and reports or calculators, you will create added value to your website and draw people back to the site again and again. You may even get repeat borrowers from the site or even new loans from people recommending your website to friends in the business. But not only does it help promote you in the ever-increasing world of the web, it also gives you that much more credibility. If you'd like to learn more about working online and marketing yourself via a variety of different online mediums, you should review the Marketing Overview and Marketing Yourself on the Web lessons. You also need to be aware that states have implemented certain restrictions on what you can and cannot do when advertising to the general public as a hard money lender, especially one who is seeking to pool funds with other investors and use those funds to invest in hard money loans. Therefore, it's important that you seek legal counsel on this matter prior to spending any money in advertising.
In the networking list lesson, you learned the importance of having a good power team that you can rely on for investing. Well, the same holds true for hard money lending. You'll need a trustworthy support system to help you perform due diligence, ensure and preserve profit margins, offer referrals, and help close on your hard money deals. Here's a list of people you should consider having on your power team. You should have a trustworthy contractor from whom you can learn the costs of various renovations and who will also provide you with quotes on properties as a means of confirming the repair estimates provided by your potential borrowers. You'll need a closing agent to perform deed searches, underwrite title insurance, and conduct smooth, problem-free closings. You'll want to have an appraiser to ascertain the values of properties before you loan money on them. It's good to have a mortgage broker to assist you in determining the risks of extending loans to potential borrowers, as well as to help you find new hard money loans to fund. They can also help your borrower into another loan so that yours can be repaid faster. Having a good real estate attorney to construct solid contracts and supporting loan documents that are in accordance with lending laws is nearly priceless. Also, in the event you have to foreclose on a property, a good real estate attorney can make that process significantly smoother and maybe even quicker. Finally, you'll need a real estate agent to provide good comparables on the properties you're considering lending on. But not only can they supply comparables, every once in a while, real estate agents can refer borrowers or help you list properties you've taken back in foreclosure. The above are the types of people you want to have on your power team. However, don't discredit the investor friends you may have made as an investor. Those folks are the ones you'll be lending to, so it's in your best interest to maintain relationships with them as well. Similarly, your friends and family can be great sources of leads as well as some professional assistance depending on their line of work. In fact, you should talk to anyone you know who may be able to provide you with leads or give you sound business advice. Take some time to build a good power team, as doing so will not only further publicize your services but also make your job a lot easier.
Excellent information, Sarah. You may have gathered from our conversation thus far that as a hard money lender, there are a multitude of laws you need to be familiar with so as to not violate them. Many of them come from the Securities and Exchange Commission, or SEC. The SEC maintains strict control over lending and money exchanges, so it's in your best interest to take some time and familiarize yourself with their practices and subsequent laws and how they apply, or in some cases don't apply, in your state. Consider having an attorney explain any questions you may have. There's a lot of confusion concerning some SEC regulations and how they apply, or if they apply, to private lending. The confusion seems to arise because, number one, each state establishes their own regulations and exemptions. Therefore, there are different guidelines depending on where you are doing business. And, number two, if you cross state lines with your lending, that is, the property is in one state and the lender is in another, the federal SEC regulations override individual state regulations. You can see the importance of having a good attorney by your side to try and make sense of it all. Here's a general guide to some concepts and information you should talk about with your real estate attorney. The following is offered strictly for educational purposes and is not intended to be legal advice in any way. First, as I just mentioned, when you lend within the same state as the property, generally only the state regulations apply. But if you have lenders and/or houses in different states, then the federal SEC regulations apply. Second, you may not be able to pool various lenders' money. Some states don't allow for that kind of hard money lending, so make sure and check with your attorney. Third, you may not be able to use the word guarantee in any of your advertising, especially if you're trying to attract funds from other investors to use in hard money loans. And fourth, you may not be able to advertise to the general public if you're looking to pool funds for hard money loans. Now, just as a quick side note, some people mistakenly think that the SEC is out to cause problems in the lending world. That's not the case. Instead, they are there simply to regulate things and help eliminate those who don't play by the rules, so that lending can be fair and profitable to everyone. Either way you feel personally about the SEC, you shouldn't pursue hard money lending without understanding their guidelines and requirements. Having said that, the SEC doesn't generally rule how you lend money or to whom you lend it, as long as it's your money and not pooled funds. You can lend your own money how you want, provided you follow your state laws.
Now let's take a look at some of the specific laws that have bearing on your lending practices. The first one we'll look at is the usury law. Usury is the act of lending money at an unreasonably high interest rate. Each state has a specific usury law that you need to know and stay equal to or lower than. Usury laws are more important to borrowers since if there was no cap, repaying loans of 50% interest or more would be nearly impossible. You may hear people who choose not to abide by the usury law referred to as loan sharks or predatory lenders. If you make a loan that is outside the usury law and get caught, not only can the loan be considered null and void, but there can be some rather steep penalties associated with such a violation. So, do yourself a favor and know what you can and can't do. There are more and more states that do not have usury laws, so you may not have to worry about this particular law when you're doing hard money loans. The second law to know about is the Truth in Lending Act, or TILA. This is a federal law that requires creditors to disclose interest rates and other information about an account. It also requires lenders to disclose the terms of a loan, including the total amount of the loan, the annual interest rate and the number, amount, and due dates of all payments necessary to repay the loan. There are federal TILA laws that apply to mortgage lending as well as local state versions in some states like California. For example, the annual percentage rate, or APR, must be disclosed on a loan that includes points and other loan fees. It can be a violation of federal law to not disclose such information. Violation of these laws could lead to a total loss of interest and principal on a loan, lawsuits, and other judicial problems.
The Real Estate Settlement Procedures Act, or RESPA, prohibits kickbacks between lenders and third-party settlement service agents in the settlement process. See Section 8 of RESPA. It requires lenders to provide a good faith estimate for all the approximate costs of a particular loan, as well as a HUD-1 or a HUD-1A at the closing of the loan. The final HUD-1 or HUD-1A allows the borrower to know specifically the costs of the loan and to whom the fees are being allotted. Section 10 of RESPA also limits the amount of money a lender may require the borrower to hold in an escrow account for payment of taxes, insurance, etc. And in addition to all this, RESPA requires the lender to provide initial and annual escrow account statements. And last, the Home Ownership and Equity Protection Act, or HOEPA, is easily the best federal consumer protection law against predatory lending. Unfortunately, HOEPA rarely applies because it only kicks in when interest rates are 8% above the U.S. Treasury rates or when excessive fees are charged. Lenders should be well aware of the rules HOEPA stipulates and, therefore, should carefully craft their loans to avoid violations. There are several documents associated with hard money lending and these laws. Most of the documents have been discussed at length in other lessons and will not be covered here. But if you want to review the documents and their use in lending, please see the guide associated with this lesson.
The process of lending money can be rather confusing for the first few times. Therefore, here is a breakdown of the process. First, the potential borrower submits a loan request to you either personally, via phone, by email, or your website. Then, the potential borrower should provide you with comparables for the prospective property, give information about the surrounding area, the amount they are putting into the deal, provide a summary of their past investing experience, offer a detailed report of the repairs or improvements necessary to sell the property, and offer details about how they plan to exit or repay the hard money loan. Next, the potential borrower, or a representative for the potential borrower, reviews the project with you. You then look at the loan documentation and determine if it meets your lending criteria. If you like the concept and feel that the numbers are acceptable, you request the borrower complete and submit a full loan packet that includes the items listed here. When you are done reviewing these items, click Next to continue. When you get the loan packet back, if it all checks out to your liking, you can choose if you'll require a property inspection and neighborhood evaluation. If you choose to do these, then consider asking the potential borrower for a deposit, generally $500, in the form of a cashier's check or money order. Also, ask them to submit a conditional loan commitment letter at that time. If the property checks out, you and your attorney draws up the appropriate documents, collects the required upfront fees, and orders a title search. Assuming everything is still up to your lending standards, then you request that documents be prepared for the loan and closing to take place. Confirm adequate hazard insurance is in place, showing you as a lien holder, and then close the loan through escrow. At the closing, you need to make sure you receive back from the closing agent or attorney doing the closing the following: the original signed note, a title insurance commitment, a hazard insurance policy, and any other paperwork you and/or your attorney deem appropriate. After the closing, it's in your best interest to make sure that the courthouse has recorded your lien, thereby securing your position on the property. Once you have everything in order, track payments made, the loan maturation date, and how much is due at that time, then repeat. You might also consider hiring an escrow company to track and collect payments for you, especially when you have a lot of loans out.
Lending money, sometimes to strangers, can be quite a nerve-wracking experience unless you really know how to protect your investment. As a hard money lender, there are several things you can do to help protect the money you have lent, as well as that you are expecting to receive. First, you should make sure that your lien is recorded in the proper position against the property. Know if there are superior liens or inferior ones, and check to make sure yours has been recorded correctly. It's also beneficial to have the original, signed promissory note in a safe place, just in case the borrower defaults on the loan. That way, even if the recorder's office didn't file the security instrument correctly, you have a copy of it and the original note to show your interest in the property, as well as a legal right to pursue it in court. Second, you should only lend to people who have some experience in real estate and who have a good track record with other loans. For example, if someone asks you to lend on a rehab project, you should take the time to verify that they've done rehab before and that they've made good on all their previous loans. This doesn't mean that you have to pull their credit necessarily, but you should talk to some of their previous lenders. In the event that you feel like making a loan to someone who doesn't have a history of investing, you may consider getting them to sign an authorization form that allows you to pull their credit, just to make sure they have at least some creditworthiness. As another means of protecting your investment, you should require that the borrower put something into the deal. Get them to put some money into the property so they have a vested interest in making sure things go well also. And finally, when you or your attorney write up the promissory note, make sure it clearly defines who's responsible for what and what constitutes default, as well as the process after default. Having this signed promissory note can be a huge benefit in the event legal action needs to be pursued.
There has been a lot of information given in this lesson, so before we get to the quiz, let's recap a little. A hard money lender is a person or group of people ready to help real estate investors and contractors obtain money that either they couldn't qualify for or didn't have time to wait for. Hard money lenders can either be private or conventional, depending on how they obtain and loan their money. Most private lenders are more flexible in the deals they will fund and will take on higher risk loans, whereas conventional hard money lenders function more like banks, with less strict lending requirements. To be an effective hard money lender requires organization, knowledge about the market, knowledge about the properties to be lent on, as well as local laws governing private lending. As a hard money lender, you should develop a power team that can assist in the legal aspects of lending, as well as the organization and recording of the correct documents. It's also important for hard money lenders to have a clear idea of who they will lend to, what kind of property they'll lend on, as well as the terms for the loans and how those terms might change depending on risk level. As the actual loan comes to fruition, hard money lenders need to know the ways they can protect themselves and the legal options that are available to them in the event of loan default. Hopefully, you have learned the benefits associated with being a hard money lender and will take the time to learn more about it in your area. You can certainly earn more money by lending it out than allowing it to sit in a bank. So talk to an attorney, get yourself set up, and set that retirement plan into motion through lending.
Please complete the following action items before the next lesson. Learn more about lending in your area so you know if hard money lending is right for you. Decide if you're going to invest with an established company or if you will venture out on your own. Determine your lending criteria for loans. Develop your power team and begin networking to find loans. Evaluate the loans that come to you and determine if you would like to lend on them. Have your power team help you do due diligence. Create the necessary documents needed to close the deal and close it.